Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into the discussion today, I just wanted to remind our listeners that if they like today's episode, to hit the like button and don't forget to subscribe so you can get the latest episode as soon as they're available. And if you couldn't tell, well, that's for all of our viewers on YouTube. I'm sure the listeners can't tell. We are wearing our Christmas jumpers, and this will be the last Bondcast of the year. So we're wishing season's greetings to all of our listeners and watchers, and we'll be back again in the new year. Right, we've had probably the busiest week of the year, well, the busiest 2 days of the year, with all three major central banks for us on Bondcast making decisions in the last 24 hours. They were all kind of live meetings. But Theo, I'm going to start with you because I think that's where we got the biggest surprise, really. We got a hike from the Bank of England after the market was pricing in less than 50% chance of a hike. So what are your thoughts there? What was the kind of rationale behind that sort of surprise hike, if you like?
Well, I guess the BOE, they want to make things exciting for us, and they wanted to give us, one last kick before Christmas. I think the point that you make is very, very relevant. We had really a meeting where there was around 35% probability of a hike in the price. We received comments from BOE members earlier in the month from Saunders, for example, who was a big hawk, and he mentioned Omicron and the possible implications of Omicron, and possibly the rationale and the logic to wait a little bit. So the market thought that the hike is not coming. We thought actually that in December the hike is not coming. We thought that the hike would come in February. However, the BOE, they made a very clear point, and that was inflation. So they received the inflation numbers. They've got a specific permission to access the inflation numbers before, a meeting. They access those numbers. They look at them. They look at inflation, and CPI is at 5.1%. To them, there is a threat that inflation expectations will become, unhinged. The anchor will be lost. It is very interesting because it happens at a time when some of those inflation forwards have actually moved down. So there were moments when the BOE could have been a lot more worried about it, but they are definitely worried now. So this is one. The other point is that the labor market has shown substantial progress. This is important. Now, the labor market was always one reason for the BOE to be on the patient side. But now that we have the labor market and inflation being strong, they feel that there is not much reason to wait. They mentioned Omicron, and the minutes show that they really thought well about it, and they know that Omicron will have a downside impact on growth. But as things stand from the balance of risks, to them, it makes sense hiking now and then possibly take an approach of a slower hiking cycle. But there is a need to hike, and that that modest tightening that they're signaling, they wanted to commence it from right now.
So you mentioned there a slower hiking cycle. What does today's move imply then for policy in 2022? And really there I'm thinking about what do you think about a hike or not in February? And then beyond that, I guess, where do you think bank rate finishes the year by the end of 2022?
We think a hike in February is quite likely. It is difficult to say that it is a given. The market right now assigns a probability of 80% for a hike. Maybe it is somewhere in the 65 to 70%. So there is a high probability. Not sure whether this would be an 80%. To us, the BOE, they will probably hike towards that 0.75% by the end of the year, by the end of 2022. But it can be, and this just mind that the BOE, they do change their opinion quite frequently. So it can be that we talk about a hiking cycle where that takes a bit longer. Some more hikes are delivered in 2023, and then we end up with a bank rate which is slightly above 1%, but that happens through hikes in 2023. So to us, There is definitely hikes are going to come. The BOE will keep a very close eye on the evolution of Omicron and any downside effect. But the important part is that if this is only growth specific, and if we talk about just 0.5% on growth in a specific quarter, that it's not something lasting, and at the same time inflation continues to be really so high, then we think that the BOE they will have obviously to act, right? So we talk about hikes in 2022, possibly a bit slower than what the market price is in, but then we envision hikes also in 2023.
What are the market implications then about, I guess, today's decision and kind of what you imply for the year ahead, and how does that then fit against the kind of trade themes that you've been writing about in the year ahead, for example?
Yeah, I think one big theme for us is really gilts relative to other markets, and we've been strong supporters of gilts relative to other markets up until roughly 10 days ago. To us, it's that gilt strength has gone, and we've seen today a significant underperformance versus bonds and treasuries. And I don't think that the other central banks were particularly dovish. It is just the relative hawkishness that came from the UK that made gilts underperform. So we think that gilts probably will continue to underperform. Mind that the negative net DV01 story that we had for the previous 3 weeks has run its course. So net DV01, even though supply will be nothing from now to the year end, but also at the beginning of the year, supply will be low. We will not have QE, in which case this negative net DV01 across different weeks is something we won't have. So gilts probably to weaken, curve potentially steeper. The way that we like expressing our view here is through wider back and break evens. And we think that this is something that can play out. We think that the market really needs to look at, more inflation premium being priced at the back end of the curve, conventional rates weaker. And the other point is really those 28 billion that are supposed to be reinvested in March. If we do have a Fed hike, then they will not be reinvested, and this is just huge, because we talk about around 15 million a basis point, of DV01 that will not come to the market. If that does not come back in the market through additional buying, and mind that timing was a timing of low gross issuance. So if that QE buying does not come in the market, then obviously we talk about a steeper curve, we talk about wider back and break even, we talk about cheaper spreads, we talk about all those themes. So these are themes that we will, like I said, we're not gonna have absolutely all possible trades and all possible views on the table. So one expression that I particularly like is on the BE side, break even.
Great, thank you, Theo. All right, over to you then, Giles, because I think that the ECB was probably the next in line of our three of most interesting central banks in the last 24 hours. We learned a lot about, the future of PEP, or rather the not so long future of PEP, and then the APP. How did that fit versus kind of what you were expecting going into the meeting?
Pretty well, to be honest with you. I mean, basically what they said was, I think, very much in line with our expectations for the year ahead. I think that the main difference was that they were much more forthright about the way that they set out the path for next year. They've actually set out pretty much a whole path for quantitative easing for the foreseeable future, actually. Now, we thought that they would be possibly, that they'd tell us that we expect to do this for Q2, and then we'll take it as it comes, we'll be data dependent and so on. But they didn't do that. They, in the press conference, Lagarde being she, President Lagarde, reiterated the fact, which should be obvious to everyone, that they are data dependent, of course, but they chose to state that they will end PEP in March. We thought that they wouldn't be, that wouldn't just be a statement, that would be a strong expectation, that they would reduce PEP, by the way, in the first quarter of next year. And I think there was a Bloomberg headline that suggested maybe it would be a moderate reduction, but actually that wasn't their language. It was just that it was going to be reduced and so it would be at a slower pace for next year. But then they set out essentially that in Q2 they'll be doing 40 billion per month, then they'll be doing 30 billion for the following quarter, and then in the fourth quarter and for the foreseeable future thereafter, 20 billion. Okay, what does that do? Well, essentially what it does is it means that there's really all the uncertainty up to obviously significant economic shocks, significant deviations from their economic baseline. All the uncertainty is now resolved. So I think that this will reduce volatility after a period of adjustment next year, and it significantly pushes back on any thought of a rate hike in 2022, because of course there's a sequencing thing where they promise not to raise rates until they have finished with quantitative easing, in the sense of they've stopped the net additions to their asset purchase programs.
That was just what I wanted to pick up on, really, because I think the markets kind of took this as a hawkish meeting. We saw spreads widen and we saw rates higher, and I think they were perhaps very focused on this kind of concrete end to PEP and the fact that we've got this schedule of tapering down the APP, but actually the ECB wanted to make a lot about the flexibility of reinvestment. I think flexibility was really the key word of the day. Is that a powerful tool, do we think, and how powerful can it be?
Right, yeah, I mean, I think the markets are right to have taken this as moderately hawkish, and I'd like to stress that was our base case for this meeting. Now, in a sense, the markets have reacted certainly in the direction that we were expecting. Perhaps the move has been a little bit more muted than we'd thought, and I think that by the time people have time to digest, and we're out of this year-end phase, which is a little bit tricky anyway, I think actually that there will be a significant move that's sort of pent up, because the change in quantitative easing, and therefore the difference in the total sort of weight of supply that needs to be absorbed by the market is going to be really significant next year. To come back to your question on the flexibilities, yeah, I mean, something that we've been repeating a lot is that you really only need to think about two big numbers for next year when it comes to ECB policy and so on. One is the $500 billion, more or less, call it $500 billion, that of more bonds that will have to be absorbed by the market overall, and that should be bearish for rates. In addition to the other bearish fundamentals of higher growth, higher inflation, and so on, that should be bearish for rates. But 400 billion is the total kind of flexibility that they have to play with just in the reinvestments between the APP and the PEPP, and if they are willing to use that reasonably freely, then that will be a significant protection. But the other thing is, and this was something I think which wasn't necessarily immediately obvious in the statement, but which Lagarde came back to when she has this habit of reading us back the statement, just in case we didn't actually properly appreciate what was in there from the start. And this was actually one of those times when I think the extra emphasis was probably justified. She was just pointing out that the flexibility, that the pledge is that they will act flexibly in all respects. It's not limited in any sense to just the reinvestments or anything like that. And so this was in response to a question about, don't we need new flexibilities in the APP? This is the standard quantitative easing program, because they had all these rules around limits for for individual bond issues and bond issuers, how much are they actually allowed to buy of each. And so there's always this concern that they might run in, they might not be able to buy stuff. And she basically just batted that back, saying, listen, read it carefully. We will be flexible if we need to be.
flexible enough, it seems like to me. So then just the final thing that, I think we might have expected maybe a little bit more discussion at least was on TLTROs. We have this liquidity cliff essentially when the minimum rate expires in June 2022. What are your thoughts on anything that she said there?
Well, essentially, they didn't really address it. They just said that they would be looking at it. I mean, I suppose that they had such a lot of, they had so much to think about just on the QE side that maybe this was just an easy one to shunt into next year. So, I think your base case now is that they will just let TLTROs run their course as they currently are planned. So that that funding cliff, if you like, when we expect banks will be aggressively repaying the money that they borrowed because this incentive rate of -1% that they are currently paying will expire in June, and so then maybe $1 billion, in fact $1 trillion or something of liquidity might just get paid back to the ECB by banks. They just go, I don't want it at the at -0.5, but I was perfectly happy to have it at -1. So I think your base case is that just expires and that the liquidity cliff is a real thing, but there is a significant liquidity buffer anyway, so that probably isn't going to concern them too much. And I think that one thing that they may come to at that point is they have this other tool which they haven't really used since they introduced it, or they haven't tweaked it since they introduced it, which is the tiering multiplier, which is basically a way to protect banks from the excess liquidity which drains back at which banks are essentially forced to lend back to the ECB at a very disadvantageous rate. And if they are taking away something that's beneficial to banks via the TLTRO, they might choose to give it back via more of a tiering allowance, and that for the front end could be viewed as quite significant. So I think that is the kind of technical discussion that I will just leave as a teaser rather than go into and ruin everyone's Christmas. If anyone wants to ask about that, you know where we are.
No, I'm going to say they know where you are.
Ah, yes, okay. Thank you, Imogen.
All right, on that exciting note then, over to you then, Jan. It feels like the Fed was so long ago, even though it was only just last night. So I'm hoping that you are going to provide a perfect refresher for us all. What did we learn really from the Fed, in the release in terms of the taper schedule, the dot plot, everything like that?
Yeah, I don't know if I'll be able to meet the thrilling money market discussion from Giles, but back to the Fed. So a couple of things, and it was certainly an eventful meeting, right? The first threshold that was passed was the announcement of doubling of the pace of taper. That's pretty much what we expected. Market consensus was for doubling by the time we got to the meeting, after both Powell and a lot of FOMC members alluded to that. So we got that. That was no surprise, which basically now tells us that taper is set to end mid-March. Second, we got the updated dot plot, the forecasts of each board member and where they see rate hikes. And that was, I would think, the most hawkish surprise from what we got last night. Next year, the median dot shows 3 hikes now, up from a half. And the year after that also shows 3. That really, the release caught markets a little bit off guard on that, which pushed the front end yields much higher, thinking that the Fed's going to go, much faster, even than the faster pricing that we had in the market. And then we also got the updated economic forecast, which again, surprising, hawkish, because the inflation, both core and headline PCE numbers were marked noticeably higher despite the increased rate hike forecast. So there's a clear acknowledgement that inflation is not going to be as, not necessarily not as transient, but more so sticky, and they have to admit that it was a lot more than what they expected, despite the fact that it might kind of like slow down next year. So it felt definitely, the release itself was more hawkish than what people were looking for.
What about the presser then? Did Powell kind of reiterate that kind of hawkish rhetoric in what he said?
Yeah, so one very important thing to keep in mind, and what I thought the presser would do exactly what happened was that the market was positioned and was expecting a very hawkish outcome from Powell. Just because every day going into the Fed meeting, we were kind of like building up expectations that he's going to basically go out there and say, we're ready to go. We're going to act ASAP. I'm not saying he wasn't hawkish in the presser, but I think it was certainly less hawkish than what people expected. And I think to me that makes sense because this Fed has been very focused on kind of risk management. They've been focused on kind of delivering things in small bits. I mean, look how long it took for the tapering announcement to be made. The market was prepared well, despite now we have the backdrop of much stronger inflation. I don't think there was a reason for them to go ahead and say, we're about to hike, we're about to go. So what Powell said was that they're planning on lifting rates not long after. The words used were there was not going to be an extended wait after the end of taper until rate hikes. So what does that leave us? I mean, there's a meeting 16th of March. Are they going to hike the day after taper is ended? I doubt it will be that quick. To me, it kind of gives a feeling of almost like being put in a corner, more panicky. But that definitely opens the room for May or June hikes. And I can come back to that later. But with the dot plots and the communication, we have also kind of changed our expectations for 3 hikes for next year for June, starting from June.
Yeah, perhaps you could just shed a bit more light on that. So 3 hikes next year, and that's up from how many did we have previously?
So we had September and December previously. In light of the faster taper expectations, we added another one in September. And now, given where the dot plot is and given kind of like how strong the inflation prints have been coming and the communication we got from the Fed, we've added another one for June for a total of 3 next year. And then we have one per quarter in 2023 and another one in 2024. Which still, if we actually get that amount of hikes, it's still above market pricing.
Okay, so I guess same question to you then to wrap up as what I said to Theo at the end. How does this fit with your kind of market outlook into next year, and particularly, I guess, with regard to the themes that you've been talking about a lot in the year ahead with, bearish rates, but being led by the belly and therefore a kind of 530s flattener? Yeah.
Going to next year, into 2022, we are going to maintain the 530s flattener and even things like 2 stands. But I think 530s here definitely makes sense because, and the forward markets, obviously, with what we have in the front end, is expecting a lot of shift higher in the front end up to the belly. But we're going to maintain that view. I mean, into year end, liquidity is going to fall off. There could be even tactical opportunities for the curve to steepen. But our core view remains of a steepener. We just think that the challenge is not so much how quickly the Fed is going to deliver, because we have 3 hikes for next year already priced in. I don't think there's a lot of good risk reward there to challenge that into like 4 hikes. But I think what the better opportunity is in looking into a little bit further down the curve and say, okay, well, the market's pricing 1.6% as kind of like the terminal, the rate where the Fed's going to end the cycle. If inflation's coming at these numbers and they're committed to kind of acting and they want to be credible under the FATE mandate, I think they might have to revisit that 1.6% assumption and say like 2.5, like lift that terminal rate expectations, which in turn should also lift the kind of like the belly of the curve and be a kind of like a catalyst for our 530s core flattener. So we're going to stick with that view, hawkish in front end and belly rates lifted by and the curve flattened by the belly.
All right, great. Well, that's probably all we've got time for today. I think we went a little bit long, but there was a lot to talk about. So thank you all for joining me today. And I'd just like to remind our listeners that if you liked today's episode, don't forget to hit the like button and subscribe so you can get all of our latest episodes as soon as they're available. And as I said at the beginning of the pod, this is our last one for the year. So season's greetings to all of our listeners and watchers, and we'll catch up with you in the new year. Thanks.